Welcome to this special Truck Stop webinar brought to you by the Motor Carriers Insurance Education Foundation. These webinars are typically presented on the second Thursday of each month at 2 p.m., but because of all the discussions that we have in our current conditions, we're bringing you the special one to update you on what we see happening in the marketplace and also reacting to our insurers' requests for certain accommodations as their business vacillates. These webinars are presented as industry updates for information purposes only. They do not qualify for state CE credit. If you're seeking state CE credit, please contact our website. We do provide 12 hours of free CE for members each year. If you have any questions, please type them in the chat window. We'll answer them as time allows or by email later. If you experience any audio problems, please note in the chat window or call our office at 800-741-484, and we'll attempt to correct the problems as soon as possible. COVID-19, a look at the effect on insurance operations and insurance. We asked James Jaillet to introduce you, who writes articles for CCJ Digest and also Heavy Duty Trucking You. This is his web address. We have myself, as you have Scott Lyden here, and I think we also have Joe Holdermeyer, who was able to come in late. He thought he had a conflict, but he'll wait us here, and as we go through, we'll hear from him too. What we're hearing in public, and this is the thing we got to start with, this has never happened before, meaning everything's shut down. Nothing has affected people in the economy like this before. We'll change how business operations now and maybe forever. We hear this public. And the part of that we learned from the past, but there's no past that can teach us what's happening today and how we react. So past history has taught us, businesses and insurers, how to deal with business interruptions and changes, but nothing in the past is like today. And so this is why we want to spend some time now where we are and figure out what we're today, and then also look at where we hopefully we're going to be in the 6 months and beyond. The first thing you do, if you haven't looked at all the public information that you hear from Heavy Duty Magazine, CCJ Digest, and those kind of things, the point I'm bringing up to these, and these are just the headlines and different articles, it's all over the marketplace. We start with the March 17th, and by the way, that's a date. That's the date I came home from the cutoff ski season on the March the 17th date. But that the truckers will shine. Freight rates hit a skid shortly thereafter. Driver layover and road quarantine missing and fading freight rates. We get involved in it. From freight waves, good news. The freight market is about to turn up. That was a couple days ago. Petition calls for more target relief for truck leases and insurance costs. So this is important too because of the insurance cost part of it. Again, just a couple days ago, volume continues to fall, now 14% below last year's average. Then from ATRA, they did a report, and obviously American Transportation Research Institution has been a great resource for us. Dan Murray will be at our annual conference updating this. They're showing where the trucks are getting less congestion, so they're getting more average speed, so therefore they're able to move freight in less time frame. CCJ Digest talks about, again, carriers report shrinking load volume as panic buying subsides, so some of these earlier demands for essential items aren't there anymore. Transport Topics talked about the spot rate market shows signs of stabilization, shifting dynamically make a projection difficult. Again, recovery hangs on spending habits of business consumers, experts say in those areas here. All this started, and Joe and I had talked about doing this webinar a couple weeks ago that we needed to update everybody. Then James Jaillet from CCJ Digest and Heavy Duty Magazine called us up and asked us about some information, and they published that. At the end of the conversation, I asked him would he assist us in this webinar that we're doing today. He said he would. So you also on the 416, the article that he did that quoted Scott and Joe and myself was published in those things, and you have been sent that information. If it's not there, it's still available to you. So, James, I got some thoughts here from you. How about talking to us through these slides and tell us what you see and what you hear, how often, a little bit about yourself and how often you keep your ear to the marketplace and how are you resourcing this? How are you getting this information?
Yeah, so Tommy, I'm a senior editor at CCJ and Overdrive magazines, which are owned by Randall Riley. And so, CCJ obviously is a publication for fleet executives and managers, and Overdrive is really, we have a really large readership there of single truck owner operators, both independent and those that are leased on to larger carriers, as well as a large readership of small fleets, which are, and for all intents and purposes, like owner operators. It's a single truck guy who expanded to have, half a dozen trucks or so, excuse me. And so we obviously have been following the COVID-19 developments from the beginning since early March, immediately when the panic buying at grocery stores and retailers caused the need for restocking. And so there was a lot of spot market activity, a lot of it based in the reefer segment, but a lot of it in dry van as well. And so what we started doing in mid-March was issuing weekly surveys to our readers.
James,
and we've been getting hundreds of. Yep.
I want to say one thing. We have some less sophisticated people, and I have to work. When he talks about spot market, he's talking about market from the brokers to today versus contract. You'll hear this. The contracts are something where your motor carrier has a long-term contract with a shipper that guarantees them some rates and some loads. Spot market is how it varies on a load at a time basis. So these are spot markets. Typically, this is coming from brokers, is it not, James? Is where you track those, the rate brokers?
Yeah, that's right.
That part.
That's right. So basically, shippers, yes. Go ahead, Tommy. Sorry.
No, and that tells us what's happening on a daily or weekly basis is when we're talking about the spot market. Just let people know what we're talking about.
Yeah, that's right. The spot market's like the overflow market for all the freight that's not on a contract between a shipper and a carrier, or even a broker and a carrier. If you've got a lot of freight and you don't have a carrier to haul it, you will put that on the spot market where a broker will nab it, and the spot market is heavily worked by smaller carriers. So
right, they don't have the long-term relationship because they don't have this continuous service. And these are things that you see posted on load boards at both truck stops and on the public websites now, that load boards where they can go in and decide to haul it or not. But I just want the audience to know why this vacillates.
Yeah, that's right. And it's the spot market is generally an indicator of broader economic health, as well as what's going on with trucking. So if the spot market is really active and there's a lot of freight there, that means just generally a spike in economic activity, or at least in freight demand. And when the spot market is dried up, that means there's not enough loads to go around, essentially. So
okay, go ahead now. Thank you. I just want to catch everybody up on that.
Sure. Yeah. So we started surveying our readers, both fleets as large as over 1,000 trucks, and as small as single truck owner operators. And we've been getting almost 1,000 responses a week across the board from fleets of all sizes. And initially there was a little bit of a spike in activity, especially for reefer haulers and dry van haulers who were moving, you can guess, things like toilet paper, between distribution points and manufacturers, as well as to the retailers themselves, like grocery stores and Target and Walmart and what have you. And that lasted about 2 or 3 weeks. And then suddenly the economic stall started to set in for trucking companies of all sizes, but especially those on the smaller end of the scale, with manufacturing shut down and events shut down, restaurants shut down across the nation. It really sort of created an effect of there's just no freight to haul. And a lot of smaller carriers that we've talked to, and it shows through in our surveys as well, they have really sort of fallen on tough times. A lot of owner operators are sitting at home because they don't have enough freight to haul, and the freight that is available is really cheap in terms of the per mile rate, which means they can't turn a profit. And turning a profit for an owner operator means, he made a little bit more than what it cost him to haul that load. And so, essentially, if at the rates going right now, a lot of owner operators that we're talking to, and a lot of small carriers we're talking to, say they wouldn't have any money at the end of that load. So, Tommy, I guess advance on through the slides. We can go through some of the comments here. So these are comments from our surveys from the last couple of weeks on CCJ. Had to shut down, impossible to survive, and that's a carrier with between 25 and 50 trucks. Again, getting back to those rates, 70 cents to $1 a mile on the spot market. That is really terrible, especially considering that when everything broke in early March, rates were going for around $2 to $2.10 national average on the spot market for a dry van load. So you can see the toll that this.
Make a note here, just so you have a reference point. When you look at the American Transport Resource cost of operating a vehicle on a highway, their last report last year came out, and this was from the 2018 area that reported they published, or excuse that they published that rate. It costs $1.60 a mile to operate a truck on the highway, not counting backroom charges and that kind of stuff. And that was with the average fuel cost at about, for diesel fuel, slightly less than $3 a gallon. So when you talk about $1 a mile, you're talking about, James, you're talking about only recovering 3/4 of the cost just to move the freight there, if based on any kind of these studies. I think that's what you're hearing, is it not, in those areas?
That's exactly what we're hearing, Tommy. And you know that if you're a really lean owner operator and you don't have a truck payment, and you know you have you can squeeze the most you can out of fuel mileage, and maybe your insurance isn't you know, too cumbersome, you know, you might be able to break even at $1 a mile, but that still is probably wishful thinking. And so a lot of the rates on the spot market are just below what it takes to operate a truck on the highway. And thus, you know, we've heard a lot this week, especially in late last week, from our readers that they're just not going to offer those cheap rates. They're going to sit at home and like a lot of the rest of us who are sort of hanging out at home waiting on everything to blow over, they're going to wait it out. So, and then here we have another. Yep, go ahead, Tommy.
No, I'll say this is interesting. They actually provided for that payroll protection plan, and they got their loan. Smaller motor, I don't know how many you're getting involved in that. I know that smaller motor carriers are having some difficulty doing that, particularly the one person with no payroll. But this, obviously, this general freight hauler was able to keep things going. And obviously they had employee drivers, because this doesn't count owner operators in the 1099 independent contract. But this was something too that I noticed, that at least some of these trucking companies are applying for this payroll protection.
Yeah, we've heard a lot of them applying for that, and mixed results so far. Some of them have reported they didn't hear back from their application. A lot of those were very small carriers, like you said. So the one here that said they received their loan obviously is a little bit of a larger operation than a one truck operator. You know, 51 to 100 trucks. That's a fairly sizable fleet, all things considered, in terms of personnel, and they likely have someone who's dedicated to managing the books and could easily go to a lender and try to secure that loan, whereas a lot of one truck operators are just that. It's literally one-man operations. They're the bookkeeper, they're the driver, they're the dispatcher, so they just might not have the resources available to apply for those PPP loans, even though that you know, 98% of the industry is of registered carriers with the DOT are you know, very small operators, and thus likely would be eligible for the PPP loans.
Yeah, less than 20 power units in those areas, and they also don't have the same banking relationship. We find that this is a triggering part too. These larger motor carriers do, but some of these banks don't do with somebody, won't deal with somebody. They don't have incentive to deal with somebody who they don't have a relationship with too. Let's go ahead. Tommy, go ahead.
Yeah, so you know, kind of more of the same on the comments here, that freight volumes are bad, rates are bad. And these are larger carrier. Well, one's a 101 and 250, and then the other is a much smaller operator, 10 to 24 trucks. You know, and that's sort of, these 5 comments that I pulled are very representative of the hundreds of comments that we received last week on our surveys, talking about how bad load volumes were and how low freight rates had gotten. And that's just basically supply and demand issues at work. There's just not enough freight, and there's a lot of trucks still on the load boards, and the metrics are pushing those rates down really cheap. And here's the broader responses to what our survey showed, which is on CCJ last week, based on 263 fleet respondents from 10 trucks all the way to those of more than 1,000. Nearly half said that they have seen freight levels decrease significantly. Another 35% said they had decreased at least somewhat. And then, you see a 3% that said significantly increased. You have to think that's something like a reefer hauler who services grocery store accounts, or maybe even a toilet paper hauler. Another 3% reported an increase, and 12% reported staying freight levels have stayed the same since the coronavirus outbreak. But I think by and large, obviously, the major takeaway is that,
less
huge
than 20%
majority of fleet. Exactly. Yeah. So, and this is Overdrive survey responses here, very much the same. A huge majority of our readers reporting that freight has either decreased some or decreased significantly. So that, between those two samples, that's a pretty good representation of the market as far as what carriers are seeing on the front lines in terms of freight availability and rates that correspond with that freight demand. It's another look at a question we asked our CCJ readers last week, and you can see the 30% line there that said they had already decreased their driver workforce, and that is due in large part to just not having loads. They can't keep drivers on if they don't have freight to move. It's the unfortunate situation there. And then, like a lot of others, they've instituted work from home policies for either support staff or management. 25% said they had decreased their non-driver workforce, and 1/3 of carriers surveyed said they pursued new lines of business. All these numbers would be staggering compared to a normal week prior to COVID, even though we didn't have this survey. Carriers generally aren't getting rid of drivers. They're always in the mode of trying to hire drivers to replace those that either left, or to have more drivers available for trying to grow their fleet. So anytime fleets are scaling back the number of drivers, it's a sign that things are not going very well in terms of the broader economy.
And it shows an indication they're trying to clean their trucks and all that, but the problem is you got a clean truck, but when they're going to the customers' terminals or they're going to the truck stops and all, that kind of cleanness kind of varies in those areas too. I think, James, that it's just tough to be out there in the public driving that truck subject to it, even though it's pretty isolated within the truck itself. But the driver has to get out, and then where they're getting out is areas where they might not have the same comfort level of control of the cleanness of it.
That's exactly right, Tommy. I talked to one independent owner operator yesterday, or 2 days ago, who said that he basically hung up the keys in addition to business being bad, but also because it was tough at shippers and receivers with the new protocol they were implementing. Not being able to use the restrooms, not being able to wait inside. They're forced to wait in their trucks, and then food availability on the road is tough with restaurants being shut down, as well as truck stops taking social distancing measures as well.
Well, and again, Pennsylvania shut down their food courts at their rest areas. I think some of them going back now and giving special dispensation to allow the food trucks to be there to service the truckers.
Right.
It's tough to go through a McDonald's with an 18-wheeler. Go ahead.
Yeah, that's right. That's right.
I went to another slide here. This is talking about the rates coming down.
Yeah, so this is just kind of like a sentiment gauge, so to speak. We asked CCJ readers to rank last week's business on a scale of 1 to 10, with 1 being the worst week ever, 10 being the best week ever. The average was just over 3.5. I think it was like 3.51, something like that. But of note, and this slide doesn't say this, but 20% of those surveyed rated the week a 1, meaning the worst week ever. And so even though that average is 3.5, 1/5 of carriers surveyed reported that it was their worst week of business ever, which I think is noteworthy.
Also quoted Avery Vice for FTR. He's talking about a prognosis that's going to be a recession. He was a speaker at our annual conference last year as the keynote speaker, one of the kickoff here. They might be, he says, might be improved, but it's going to be worse than the Great Recession. This is the long-term situation that you have here. So even some people who specialize in this are very pessimistic we're having here. Scott and Joe, do you have anything you want to ask James about the current conditions that can be added to this? Or Scott, are you hearing the same thing? You guys are hearing the same thing?
We're hearing the same thing. I think you did an excellent job explaining it.
So this is what we're heading into, folks. We talked a little bit about the current business might be a consideration when thinking about how to help deal with insured that are for-hire motor carrier. This is what we want to try to end up here. This is not the recession in the 2008 and this is the thing where all the industry just slowed down. It didn't shut down. This happened quickly. I mean, overnight. Again, I was skiing 4 weeks ago before they shut the prices down. And also, James, it doesn't affect all truckers. They're ones that are hauling essential items, as you said, had an uptick early here, and there's some still hauling that, is there not, in the marketplace, that their business is still good if they're hauling, as you say, paper goods or some of the food items and that kind of stuff. You're still seeing, that's that 20% you showed in there that had an increase or stable here. But dead stop. If you're auto hauler, your flatbed hauling building material, hauling appliance, manufactured goods for households, that kind of stuff, that's where they just stopped overnight. And I haven't, James, I don't know how long you've been doing this, but I haven't seen where the whole thing just stopped overnight. Isn't that the thing that's different than most any kind of other businesses that we had?
Yeah, that's so I'm not that old. I did start covering trucking during the, I guess, right as the recovery of the Great Recession began in early 2010. And so, the whole time I've covered trucking, it's sort of been in a growth situation. And obviously, no, we've never seen anything like the dead stop. And I would even add to your list, Tommy, the oil production that drives a lot of freight. The oil field activities see a lot of flatbed freight. They see a lot of loads of crude oil in terms of tankers, and that has been completely shut down, both due to economics of, both through the coronavirus pandemic as well as the crazy issues surrounding the oil war between Saudi Arabia and Russia and influx of supply. So that's another big area that, there's just all facets of the economy that you don't think about providing a lot of truck freight coming to a dead stop, like you just said.
I was listening to the Rug Dog radio show the other day. We are involved. There have been speaking. In fact, I'm going to be at Mark Willis's show in a couple of days on his show at 2:00 in the afternoon. And I heard that they were talking about the oil fields out of Texas, that they were stacking the equipment. So they're busy right now. But once they get all the equipment from the sites back to the right processing yard, they're going to have anything to do. And they're also talking about their kind of trucks. And this is another problem you have. Those kind of trucks aren't adapted to then haul a reefer. They don't own a reefer or haul a reefer. So even the configuration of the truck doesn't lend to changing their types of operations. Scott, you talk about, your guys are talking to you about it. Is this what you're seeing in the marketplace that's different than what we went through when everything slowed down? Some of the things are the same. We're going to talk about in a few minutes about I need to park one of my trucks and some of the industry reaction to that. But this just with no warning.
Well, with regard to the economy, you're right on. I listened to Bob Costello, American Trucking Association's webinar recently, and he said we're absolutely in a recession. The only question is how long it's going to last. There were 17,000 jobs lost so far, according to Bob. There were 9,000 jobs lost in the 2008, 2009 recession. So already almost double the number of jobs lost. Here in Orlando, Disney World's been closed for almost a month. This week, they announced they were furloughing, which means they're going to stop paying 70,000 employees. So I think it's going to get worse before it gets better.
Yeah, I think I saw this morning, I didn't look at the same number because I was trying to prepare for this, that the last report that came out yesterday was over 20,000 people applied for unemployment. 20 million people applied for unemployment last week. I don't know if you saw that or not. That was the report that just came out. So it's a tough time. The government has made some considerations and put some things off to try to relieve things about if you hold essential goods, then they're waiving the hours of service. They're waiving the any kind of inspection. I have actually heard a couple webinars that are done that even the violations of tires and things like that. How many have you had any feedback, James, about how this other than confusion of what some of the suspension of the regulations are? And Scott, have you had any of your insureds taken advantage of these regulations about with speed and the inspections and allowing for some of the things to be tracked?
We have not. If there's no freight to haul, and if you're getting ridiculously low rates to haul it, what difference does it make if the regulations are suspended? There's just not freight to haul right now.
Right. And James, have you seen any reactions to how the truckers have reacted to these suspensions of stuff and have taken advantage of it or not taken advantage of it?
Yeah, the big story initially when the regulations were suspended was, a lot of what we heard from fleets and from owner operators and drivers was that they were treating it almost like a free-for-all, that they considered almost every bit of freight to be essential at that point. And, we're really, we talked to several owner operators who reported turning their ELD off, which is their logging device that tracks their hours of service. And but like Scott said, in the last couple of weeks, that narrative has sort of died down too, just because there's such a dramatic slowdown in freight that even though the regulations are suspended still for essential loads, just not a lot moving.
And the problem we hear from looking back on this, James, that concern us, if we have crashes now, is it going to be because the driver was fatigued and they worked too long or not? I mean, those are things that the insurance industry deals with after the fact. This sounds good going up front, and we haven't seen any of those results here, but that's something that we, the insurance industry, worry about how we then defend this stuff in court later. Particularly, as you just mentioned, they thought it was a free-for-all, and so it's going to be back to, was it an essential load or not? Was it one of these or not? And they're not. And I've heard a lot, listen to the road dog radio shows, that a lot of times they push that envelope and as you say, they just turn it off. I just kind of put loss of business. Past customers have nothing to haul. That's the gasoline and those things. Low rates, more capacity, lower rates. How about this fuel cost? It's the lowest it's been for almost ever. Obviously, the gasoline haulers in this. James, are you seeing anybody who are saying that this is helping some part of it? I have said before, for about every 50 cents a gallon, it saves the insured about $6,000 a year, about $1.25 a week, based on an average 100,000 miles a year, and then an average getting somewhere around 8 miles to a gallon. But this has helped a little bit. But have you heard any reactions concerning the fuel cost?
Well, Tommy, the fuel surcharges have been pretty much ubiquitous since when we saw the opposite in 2008, 2009, 2010, which was sky high diesel prices. So, I did talk to one owner operator earlier this week, and she mentioned that, fuel costs are low, but they dropped faster than she could update her surcharge. And so in a sense, it was, there was some issues there regarding, whether she would be able to make sense of that, so to speak, as far as with the customers that she had been working with. And so, to a degree, I mean, the idea of the concept is sound, that it could save small operators some money if they do have loads to run. But, there has been pretty much widespread fuel surcharges in place for a decade or so.
But the fuel surcharges would not affect the spot market, would it? It's more contract.
It's on both markets, but yeah, it is more baked into the contract side that,
Right.
you know, based on an average of what diesel costs and that kind of thing. So,
Scott, I think you shared with me earlier, though, your insurance is saying, I don't care how cheap fuel is, the rates are still so cheap that this doesn't make up the difference.
That's correct.
Less traffic, more productive per unit. This is a problem we have here, less congestion, so the more miles and less time. And so our whole, James, our whole insurance concept rating concept is exposure means how many miles I drive. And most of the premiums that we deal with have some function based on usage, and that's the miles that they drive. So having more miles per unit is a problem, but there are fewer things to hit out there. That's the good part about it, and hopefully there are fewer claims. I don't know, Joe, I don't know if you can tie in here or not, or Scott, I don't know. Are you seeing any kind of, or any numbers about crashes happening and reduction in crashes, or any claim frequency that you would have expected that's not happening now?
I think it's too soon to tell, Tommy. It'd just be speculation yet, but that's something that's going to be looked at for sure.
Yeah, James quoted me an article that right now it would be a good time to write, maybe for what, 2 weeks, 3 weeks. Don't worry about going through Atlanta, and that'd be a good place here. The other thing is, though, that this is part of it, is that the truck driver now is looked very favorable. We didn't include here, but the president gave a lot of accolades to the trucking industry a couple of days ago with a meeting in Washington that was orchestrated by the American Trucking Association. So maybe this adverse looking at a trucking and a truck driver as something that's a danger on the highway running over people might see these are one of the essential function of this marketplace, because James, as you said, these are the people who are bringing the food and the toilet paper back. So a lot of respect for the trucking industry in this area has. And I don't know if you survey these kind of things and what the public thinks of a trucker, but I see a lot of positive things coming out of that. Do you have any feel from your contacts, James, about how they see now that they are now better recognized and people tend to appreciate them more?
Yeah, I definitely agree that that's one of the themes of the last month and a half or month or so, Tommy, that there is a sudden recognition of, hey, the products that I go to the store and pick up every week or every day, I get there somehow. And I think there's been some, a lot of recognition that is a truck and a driver and someone who's away from home and working hard to make that happen. We don't really have a lot of data about, industry image from a public standpoint, so to speak. But I know that one of our other editors, Aaron Huff, did do a piece a couple weeks ago along the lines of, once things get back up and running, there could be more goodwill toward the industry in terms of court cases and settlements regarding truck crashes. So I think that is a potential positive in all of this.
And we have to build that in the future. By the way, Aaron has committed to be a part of a panel at our annual conference in October this year. He was there the last couple of years, and we've had a relationship with him back in the Salt Lake City areas, the visit there instead of the Alabama, the rest of you. So for you who are listening to this, we're still planning to have the annual conference in October, and Aaron will be a part of that thing. And we might even have, I'm going to talk to James about things, depending on where we are now, that we'll talk about since that we are introducing now. But hopefully this will be favorable in the future. One of the things, though, that we run into that maybe is a different marketplace, that a part of the public perception here, and we're getting back now to the insurance consideration. This is where I want to spend these last few minutes with here. The personal auto carriers are giving a discount. They're giving some 15 to 20% off of the monthly premiums here. I haven't seen mine yet, and listen to all that kind of stuff. And this is dealing with the personal vehicle. And in those ways, I think that from an insurance standpoint, there is less use of cars. This is affecting the fuel costs. This is affecting a lot of things on the highway now, the less the congestion. So they could come up with the average that know that the usage is not there. We have a dilemma now because in our case, some of our truckers are traveling more miles because of the talk about the fuel, the congestion, and more traffic, and the waivers thing here. They also have the state reaction. All states have reacted to concern for staff. Please do not cancel for non-payment. The insurance provider cannot cancel policy for non-payment in Ohio, New York, California. In those areas, it'd be nice to. Scott, you and I talked a little about that. I have a copy of the New Ohio and the California one saying that we cannot cancel policies. I know you write a lot in Florida, and I know Florida has not made a statement concerning commercial auto in that area, but how are you reacting? And Joe, again, I don't know if you can tie into this stuff because you, with Amwins, you've got a broader footprint than Scott does here. What are we hearing from our insurance providers dealing with what the states are mandating that we can do?
Well, Tommy, the leading writers of tractor trailer liability insurance in the United States, companies like Century Insurance Company, Canal, Lancer, National Casualty, National Indemnity, Occidental, Progressive, Berkshire Hathaway, all of them responded quickly to the situation. All of them are waiving their usual restriction against removing an owned tractor from the insurance policy. If a tractor is parked and not being operated, insurance companies can remove the insurance coverage from that tractor and stop the premium payment. If it's a larger insurance company that pays their premium based on miles or revenue, then monthly minimum premiums and annual minimum premiums are being waived so that the premium is reduced to accurately measure the reduced exposure. These insurance companies have been doing a great job, in my opinion, most while dealing with their own issues like transitioning their employees from working in the office to working at home.
And the reaction to the states, they're recognizing this without this, just even though the states are saying this, they're doing it themselves without some state mandates. So basically what you're saying is in these situations we're talking about, they're making some adjustments based on what is practical for our insurers reacting to this problem. That's a positive thing here. And we say here, and this is what Scott just went through, each insurance company will make a decision about how to handle these things here. My thought in this, Scott, is unlike personal autos, and this is something that the carriers are looking at. And so when people are comparing the personal auto insurance carriers, the private passenger auto insurance carriers versus commercial, the underlying factor that we have is that the 91X and MCIEF 90s require us to pay. So if we take a vehicle off a policy and that insured uses that vehicle later, even though it's not a covered auto anymore in our policy, it's going to be subject to us having to still protect the public, meaning the insurance industry, because of 91X MCIEF 90. And this is when Scott uses a very good firm. The insurance companies are reacting very favorable to our insurance consideration in this area. And this is the hurdle that we're over different than personal autos. In fact, when we look at the current policy setup, and this is getting maybe too far in the weeds, is that the concern we had before is when our insured was using non-owned vehicles, because most of those kept busy by owner-operators that would cover a hired auto. This is where you have owned units that are parked now, and that's a concern that we would have to still react to. So if a crash happens, then the unit would not be a covered auto, so the insurance company will still have to respond. This is the thing. So this is the old rule. We got to insure all vehicles 10,000 GVW or larger on our policies. And James, that's things that you and I talked about that's different than personal autos. That's the underlying problem with how we adjust that. And this is where Scott's saying that these insurance companies are not enforcing that rule today because they are parking vehicles and making these adjustments, where before, Scott, we don't have to remind people, but we've had it before where unless you show it sold or bill of sale or cancel lease or a picture with grass growing up around it, it's not going to be taken off the policy. So that's a concern.
That's correct.
And so this is them involved in case, but it's used interstate. So hauling a load would be a problem, but just moving a unit maybe not be. And this is a thing here where there's even MCIEF 90, there is a little provision here. They only come in place with interstate commerce or if the insurer's using their authority to haul something. So if they were hauling a load, it would be a problem. But if it was just moving it from point A for maintenance and things like that, then the MCIEF 90 and 91X would not come in place in those areas. So that's a consideration if it ever comes to court time in those areas. Essentially needed here, what we're talking about, we're already talking about what can be hauled, what's essential, what's needed, and what's not needed. And this is where we have. What is the typical property they haul? Faster, less traffic, so more miles per unit if there's something to haul versus less freight to haul. So the unit real miles driven becomes something, and those could be tracked now with electronic log devices. Our premiums are usually based on number of units covered in their auto policies, and that's the fraction of premium base, either because it's miles related or unit related. And so this is the adjustments that Scott was talking about that the insurance carriers are making today. So insured asks for cancellation, modify their policy, or they just stop operation of payment. So what coverage are they talking about relieving? Auto liability, physical damage, cargo, GL, work comp, OC Act. In those cases, Scott, I'm sure that you're getting some of these requests, but when we look at this, a lot of your insureds, when you say take it off the policy, we have a lot of policies that combine auto liability with physical damage, and we understand taking the auto liability or giving considerations there. Cargo would not be exposure, but a lot of them still have a physical damage exposure they can't take off, and if some of them have terminals or not, then their GL would not be affected. And again, work comp would be audited basis, and that's a concern we have. But by that token, in those things too, you could have a payment there. How, when they ask you to modify this, what lines are they dealing with, and what lines are these companies are more able to react to?
So the requests vary. You're correct. If they have a lien on the truck, they're not asking us to take the physical damage off. They have to keep that on the insurance policy. It's usually the liability and cargo lines are asking us to remove. But regardless of what the request is, the insurance companies have been responding fantastically. They're very accommodating. I haven't had any problems with any of those insurance companies with our requests. That's good.
We also, what state requires, again, where you do California, Ohio, those items here, so you'd have to confirm that. And again, are you seeing, so they're not even canceling the 91Xs, then are they not in these kind of cases here, even though they take the vehicle, if they cancel the policy or not, Scott, or how do you see they're handling those? Those you obviously have to give the 36-day notice cancellation of the MCIEF 90 part of it versus a 91X.
Well, they're not canceling the policy, so we haven't had any BMC 91X filings canceled at this time.
Okay, good. And of course, the thing that from the agent standpoint, there's a big difference between your direct bill and account current. And the only thing I'll point this out, direct bill is where the insurance carrier has a program where they direct bill, and therefore the agent, the retail agent, is not have any potential liability for uncollected premium. On account current, they still have a responsibility for uncollected premium, and those things, and people who are listening to us that are on account current basis, you need to make sure and verify everything that Scott's saying about the market that he deals with to make sure that they have the same attitude. There's also something about the insured request and part of it. The reason I threw this in, and by the way, I listened to a webinar that Rob Mosley did yesterday, and he brought the same thing up, even though after we had it written here. Some of the premium finance companies are requesting non-payment, and that's a different consideration because a premium finance company, reason they have an opportunity to ask for cancellation of a policy for non-payment is because they have a power of attorney of the insured. So it's an insured's request to cancel the policy that we have to act at. Scott, I don't know how many of your policies are premium finance or not, or have you, and how the premium finance companies have run into this problem.
We don't deal with premium finance companies, so that has not been an issue for us.
But you can see it could be. Do you agree with me there that this could be the gray area that we have in this part of it here?
Absolutely.
So owner operator, let's review as we bring one truck, motor carrier with their own authority. They cannot pay the premium. They cancel the policy or they can suspend coverage. And again, Scott already talked about the liability, the cargo, but not the physical damage talked about here. Lease to another motor carrier. I don't know how many owner-operators you write on non-trucking liability policies, but sometimes that they will want to keep that in place. First off, the premium's pretty low, but a lot of that's got physical damage involved in it. Do you see any how your non-trucking liability policies react? And I don't know, Scott, if you write enough of those to have an understanding for that.
Really hasn't been an issue. The non-trucking liability premiums are so low that most of them in our agency are paid in full at the beginning of the policy period. And the physical damage is just like on the regular scheduled unit policies. If they have a lien on them, they're not going to be taking the physical damage off. So I don't think we've canceled or modified a single bobtail or physical damage policy.
Yeah, I would think that's the way I would look at it, because the physical damage is $35, $50 a month, and by the time you do this, and they had other considerations. And the advantage of being non-trucking, that at least now can move it for maintenance purposes and these kind of things, versus if there's taken off the policy, and where would you park the truck off the policy? If we want to cancel the whole policy, and again, liability policy, we're now talking about cancellation. And my concern is later when our insurance companies now, and they want to start up again, because they still in a lot of cases would own the truck. It won't be a new venture anymore, but I would be concerned about the business plan. This gets back to what's happening in the future, Scott, and maybe we got to think about this 60, 90 days ago, when your insured has canceled their policies or taken things off. Now they're going to start back up again, and now they start back up, we're going to have to get more down payment. We have to deal with that. Have you thought about long term in those kind of areas, for particularly somebody with one truck?
Yes, that's an interesting question, because now, prior to COVID, if a guy had a lapse in coverage, say went under lease to somebody, dropped his own insurance, 6 months later decided that wasn't the best thing for him, wanted to go back on his own, there's only a handful of insurance companies that will write that policy because it's considered to be a new venture for insurance purposes. But now you might have a lot more people that have short-term cancellations because of COVID. How's the industry going to react? Are they going to consider them to be new ventures and only a couple of insurance companies will write them? Or will the insurance company that was writing them before forgive that and say, yeah, we'll take you back? Nobody's made an announcement on that yet. I've got some opinions how that might turn out, but right now they'd be considered new ventures.
Yeah, that's why I brought this up, because I want to think when we get over this crisis now, and this is going to happen again, and again, being fair about it, Scott, this is why I brought this up. And James, I hope some of this you see more about our industry. I'll leave you out this part of it because it's a lot of insurance, but I think after I talk here, you see some of the moving parts here that you weren't aware of before, I would think.
Yeah, that's right. That's right. A lot of questions in all of this, for sure.
Now, motor carrier with 20 to 20 units. This is written on a specified auto basis. The insured asked to remove a unit. As Scott said, they're taking the units off and they're giving the credit now. There is an ISO suspension of insurance coverage endorsement, CA 200240, that can be used that suspends coverage in this area, and you could use that for one unit or some others, the part of it in those areas. Or I have made some suggestions before, Scott, to move it to a non-trucking status for those units off. At least that way they can do maintenance. You mentioned earlier that a few carriers are doing that, and a few carriers are having the insured sign things when they take the unit off. Could you talk a few minutes more, just talk a few seconds about what the individual carriers are doing once they take the units off? Are they requiring any endorsements, or are they asking something to be signed, or some of them are offering non-trucking instead of just taking them off?
So again, it's a mixed bag. The leading writers of truck insurance, the companies I mentioned before, are all allowing units to be taken off and forgiving premium. How they do it varies from company to company. Some are using the CA0240. There's another ISO endorsement, the form CA8441 for temporary auto liability exclusion. Some are using that. Some are making the insured sign a form acknowledging that he won't drive a vehicle, and if he does drive the vehicle, or if they get a DOT inspection showing he was driving the vehicle while it's supposed to be off the policy, then they're backdating it to the beginning and charging the premium. It just depends on each insurance company, but whatever they're requiring is not too burdensome. It's not really an issue. We're getting it done. We're getting it done quickly.
And that's the point here. There still needs to be some protection that people who are taking opportunities of still running. They might run without doing the stuff in the part here. The easier ones, obviously, and this is the fleets where have more than 20 power units. They're written on some kind of monthly reported form. This is easier because of the report. But what I also want to remind our retail agents who are writing fleets and monthly reporters, most of those monthly reporters have a minimum monthly payment or also have an annual minimum. And so those aren't going to be met now. So you want to talk to your insurance carriers who have, even on the monthly reporter, to make some adjustments in those annual minimums and the monthly minimums up front instead of you waiting until an audit happens later. So these are things that we need to react to on the fleet policies. You need to be proactive. Scott, are you contacting the insured any way to talk about these things? Are you seeing where they stand now to find out where they are? And then what do you do when you respond? When they call and stop payment, when do you see that you need to be involved?
We're notifying by email what their options are, and pretty much all day long, that's all I'm doing is answering calls from insureds who want to know what their options are, what they can do. And I encourage, if it's a trucker out there listening, to be proactive and talk to your agent. If it's an agent out there listening, be sure to understand what each of the insurance companies you represent requires, what their guidelines are. Most of them have put out written guidelines. You just have to be proactive, like you said, Tom. You have to know what's going on.
Yeah, and this is part here. This is keeping the customer. This is your book of business, and we got to keep it here. This will be over, hopefully, and we're back to business. And so we got to react now. James, this is pretty well where we are. We talked a few minutes as we took this. Tell us what you're seeing or hearing from people moving in the next 3 or 4 months. What are you getting the feel from the truckers themselves?
Well, obviously, Tommy, that freight is expected to remain at depressed levels throughout April and into May. I would say the lone potential bright spot for freight activity is, I did talk to one cheese hauler this week, and he said that his restaurant customers were preparing to possibly either ramp up their food making in terms of delivery and pickup, or possibly even open again, depending on what state governors do. And then I saw a story yesterday that said Bobcat and another manufacturer of heavy equipment were reopening their manufacturing plants on a limited basis. And, for those factories to operate, they need truckloads of parts and materials coming in. And then obviously they require a truck to haul the finished product to a dealership. So as more restaurants come back open, and as more manufacturing facilities come online again, I think over the next 4 to 6 weeks, that's a potential area where we could see an uptick in freight activity.
But the downside of that, the rate still might not be worth hauling enough in that part of it. So even though the uptick in trying to span this, it's going to take a while, I think, before the economics come back to some level that our insureds can be consistently on the upswing we have, making enough money to keep the trucks on the highway and these kind of things. James, this is the very end of our last slide. Scott, you have a couple of closing comments, and then James will ask you, and then I'll close this out.
Just what I said before, if you're an agent, be proactive, know what your insurance company guidelines are. This is your livelihood. Stay in close contact with your insureds. Everybody's concerned. Everybody's worried about their own businesses. Just be proactive.
James, you want to say something in conclusion?
I would only say that, some analysts think that there could be a rebound later this year, starting in the third quarter, and then perhaps ramping up in the fourth a little bit with freight activity. And there's going to have to be truckers and trucking companies to haul that freight. And so, while there are a lot of truckers sitting idle right now, I think they would chomp at the bit for an opportunity later this year to get back on the road and start working again.
Yeah, they're going to be kind of a distance themselves, shut down and no place here. For you who are listening here, I hope this gave you something out of it, which basically, as Scott said, you need to find out whatever all your insurance carriers are doing. Be proactive dealing with your insured. Talk about, can we help you, and here are the things here. The other thing we hope you have here, there's a lot of public information. We talked about the two sources that we have here, CCJ Digest and HDA, Trucking Info. Those things, you need to be active. If you're going to be active in this marketplace, you need to listen to see what's happening. And you see the information that these publications can give will help you understand the motor carrier's operation to help you react to it. And just like other webinars that could have been available, the ones we made available for people yesterday from Rob Mosley's office, you mentioned, Scott, you mentioned the one that was done by American Truck Association with Bob Costco. Those things are there. So you need to stay abreast of this. And as a part of the Motor Carriers Insurance Education Foundation, we'll bring you more of these truck stops on a more regular basis, trying to let you know what's happening from our viewpoint, from the insurance viewpoint. So we're closing this. Everybody be safe, take care of things, and we hope we'll all get through this and look to something in the future very soon. So with that, we're off. Thank you again, James, and thank you, Scott, for your time today sharing your information.
Thank you, Tommy.